Okay, so my name is Gary Sawka, and the topic for today is alternative credit. Over the past few years, I've probably done about a dozen of these panels with the IvyFON group and Marty, and we try to make them fun. I try to make these fun, get a lot of alternative presentation and questions. And look at this, I haven't even started and I already got a question from the audience. It says, what's with the red shirt, dude? Well, it is the recall election today, and I had to show my colors before Gavin deports me tomorrow. So, this is the way I thought we'd do it. First of all, I'm going to go through the four panelists. Hopefully, they're all here, and then we'll go and give a 2 or 3 minute introduction. But before they start talking their book, I'd like them to talk about, introduce it, their whole, portfolio allocation, risk management, seeking out alpha, and so on. So I'll start first, since I'm the one standing up here. Gary Sawka, I've been for the past 14 years on the board of a global container leasing company, CAI International, and we've gone through a lot of strategic reviews. It's a large financing operation, crises management with the pandemic, and restructuring of a couple of our businesses. In addition, I'm on the board of directors of a company called Digital Solid Space Propulsion. It's an Incatel venture funded company, and it's a CIA has its own VC firm, and so I've got CAI and another one that's founded by the CIA. So they're involved in non-explosive propellants that are electrically charged. They do a lot of stuff for NASA, the Air Force, the Army. They were not the guys that hit that mistaken drone that hit those relief workers instead of the Taliban. And then they're also involved in pyrotechnics in terms of electrically charged firecrackers or pyrotechnics, and have now got involved then in the Nevada film industry. So in terms of who we're going to talk to for the rest of the people, I think I'm going to talk and let me introduce Alan Schneider, who's been a guy who we served on several panels before. Alan, Shinnecock. I thought that was a New York Indian tribe that just lost their casino license, and now they're in art lending. Tell me about the name and introduce yourself.
Sure, I'd be happy to. Thank you, everybody, for being here. Yes, Shinnecock Partners. I stole the name from the Indians in Southampton, and then to really make it confusing, moved out here to Los Angeles, where I live. What is Shinnecock Partners? It's a family office investment boutique. I started over 30 years ago. It's sort of a humorous story. I was running, or maybe they were running me, all the product areas for a major securities firm, and had just finished with a couple of other people launching the Discover card. And I said, it's no fun. So I quit. And then I woke up, oh my God. And I said, I know Wall Street never met a fee they didn't like, because I was guilty of that as a young punk. Second, Wall Street is frequently casual about risk. And I had a few pennies and I didn't want to lose them. So I started Shinnecock way back then. Knowing I'd toddle off and do other things, I created an all-weather fund for me and a few other friends, and motored along for years and years. Came out here to get my head handed to me, restructuring a $20 billion insurer. Oh my God, with $18 billion in high yield bonds as Drexel was going under. Oops. Successfully restructured that. Then started a web company, which eventually grew and became, using the web and call centers, the largest seller of auto and home in a comparative choice platform. Sold that, came back to Shinnecock full time, and became enamored of niche investments. We talked about that, Gary. Today, one of our major focuses is specialty lending. And a subset of that is, oh my goodness, lending against museum quality fine art, which I would argue for any risk averse people is terrific. High yield, we control the collateral, et cetera, et cetera. So we can get into that maybe a little bit later. Thank you.
Okay, that was a good one. And I'm going to go to the next person who was generous enough to share his Zoom link last night so we could have a pre-call. And Shant, you can tell us about an introduction to yourself and your business.
Hi, Gary. Thanks for having me on the panel. I'm Shant Sood. I'm a managing partner at Sanctum Capital Management. Sanctum Capital is an alternative investment firm that makes debt and equity investments into fast-growing mid to late-stage technology companies. Unlike venture capital, which we all know very well about, which is structured mostly as venture equity, venture lending is vastly underserved, undermarketed, and often misunderstood. And we believe there remains significant opportunity for high risk-adjusted returns still in this segment. My co-founder and I have been successfully investing into technology companies over the past 20 years and through market cycles. So we've got a ton of pattern recognition in terms of how technology companies look and behave during downturns. And certainly we're at the peak of another cycle here. We're currently raising a direct lending fund that'll invest 5 to 25 million into each portfolio company. Our investments are typically structured as senior secured term loans with a target yield between 11 to 15%, mostly cash pay, plus upside through warrants and equity investments with ample co-investment opportunity. I look forward to our discussion. Thanks, Gary. Back to you.
Okay, so then also on last night's call was Mark Watt, and he's involved in a little bit different area of the venture lending, but why don't you tell us about it?
Yeah, great. Thank you. Thank you, Gary. Marty, thank you. Pleasure to meet everyone this morning. And it's an honor to participate in such an illustrious panel. As Gary said, I'm one of the co-founding general partners at Kilonova Capital. Kilonova is a globally focused growth capital firm that invests, buys, builds, in private technology companies. We observed as one of the foundational premises that over 50% of private technology companies that have received institutional venture investment now lack a natural fit capital partner due to market distortions that are changing fund incentives. And what this means is about $150 billion worth of invested capital in technology companies, and these companies are today struggling to raise their next round of enabling capital. And so we work in partnership with management and existing shareholders to create an investment solution that best positions the company for growth, for value creation, and the alignment of collective interests. And that manifests in three sort of typical different ways that we invest. We either provide growth equity, we provide low leverage buyout, or we provide structured equity or debt investments. And just given that this is an alternate credit panel, examples of the credit that we're typically providing are creative credit solutions to enable growth. We've been particularly active around providing bridge or mezzanine financing for companies that still believe the SPAC market is open, but certainly treading towards a traditional listing. We've provided a lot of forward flow credit financing to sort of the fintech community. We're lending to lenders. And we've also been quite creative in terms of looking at deep technology companies, semiconductors and space companies and emerging frontier companies that have got valuable under monetized IP. And we've developed some creative credit solutions around that IP strategy.
Well, that's good. And you said it without taking a breath, which is great. That's great. But
you should see me deep diving. I can go underwater for 6 minutes.
How about the name of the company? That sounds like maybe an Irish golfer or something.
No, it's a little bit grandiose, and I was trying to avoid that. I mean, if people were to look at my LinkedIn resume, they'll see that I have a habit of getting involved in complex situations. And so I have either co-founded or invested in about 15 different space companies, from rocket launch through multiple satellite constellations. And so I have a deep and long-standing passion for astronomy. And a kilonova is the collision or the implosion of two neutron stars. And astronomers believe that kilonova events have created all the heavy metals that exist today in the universe, including gold and platinum and other highly valuable metals. And so a little bit grandiose in believing that we can participate in those value creating events.
Well, that's a mouthful. I think maybe you have to be a Baker scholar like Alan Schneider to actually understand all of that. So, okay, now we have Peter Burns with Burns Funding. I guess we don't have to ask you where you got your name. So Peter, why don't you tell us a little bit about your gig?
Sure. So thank you very much for the opportunity to be here with these illustrious financiers. I'm the little guy in the block because I'm at the lowest level of startups, and I use capital that's debt capital. And I basically got into this because for the last 46 years, I've started about 150 to 200 of my own companies. As a teenager, I'm the one that brought mopeds into the United States from Europe and rented them. Scaled it to 100 locations, bought all the commercial real estate, et cetera, et cetera. Got into education, entrepreneurship education, because I started at the McIntyre School of Commerce at UVA with my business plan that affected the moped rental business here in the United States. So over the years, I had to finance all my own businesses. So I had to get pretty good at alternate financing, because way back when, in the 70s, when I started, entrepreneur was like a four-letter word. We were the redheaded stepchildren. It was all about Wall Street, Gordon Gekko, all the good stuff. Everybody wanted to be an investment banker. And indeed, my two younger brothers were investment bankers who turned into very successful people. My brother Michael played that into Lionsgate Entertainment, the largest independent film company in the world. My brother Kevin has his own hedge fund. I'm the play handball against the curve startup entrepreneur. But I've managed to put together debt and lend out about $600 million in my career. And I now am involved in a very interesting application of all my 46 years of experience. I'm helping young women, millennials, get into business by providing startup capital. I can enhance their credit. I can repair their credit. I have bridge funding to pay down their debt ratios to get them the best FICO scores. And then I have accumulated about $1.5 billion worth of debt capital that I can loan by guaranteeing it and make it non-recourse money to the individual young people that I select to fund their business. Now, they're in no way big companies like you all fund, but they are a stepping stone, and there is a ton of opportunity in these startup businesses. That's what I've been living in for almost half a century, and that's where I'm going to stay. So that's kind of it in a nutshell.
Okay, that's great. Now we have another person that wasn't on the list before, and so you're new. Ravi, are you actually on this panel? And if so, introduce yourself and tell us about what you do.
I'm not on this panel.
Oh,
I'm
you're
not on this panel. No, I'm not. I'm on the
Okay.
FinTech panel.
All right, so that's well,
Sorry.
we had one guy like that last time. No, that's no problem. Okay, so now we go to talking about alternative investments. And so, years ago when I was working for ITEL, Sam Zell said, never invest in a AAA credit and only go down. But then I got to a company that they said, always invest in a AAA credit. And this was 2008. They said, always invest because you can't lose money. And I said, oh, except for Freddie and Fannie, AIG, CIT, WAMU, GM, and Chrysler. So there's, sometimes risk is not as it is apparent. So we've got a panel here that will like to talk about a lot of things that we wouldn't normally talk about before we talk our book. And that is really today in this time, what's your portfolio allocation? Is it outside of California, Texas, outside the US? maybe you're a Tesla fan, you're gonna be shot out of space for a while. You know, risk management and the, you know, how do you control seeking alpha at the same time as hedging volatility? What about inflation? What about, you know, the social engineering going on in this country? So I think each one of us, just give us what's at the top of your mind in terms of how you personally and professionally talk about those factors and what would maybe spark the interest of the audience. And I'm going to use Alan because Alan can come up with 20 different alternatives, which kind of wore a pen writing them about. So Alan, why don't you start off with some of your ideas?
Well, so everybody, I'm prejudiced. I would say niche investments is where we live. And I think niche investments are extremely compelling. Why? Because if it's a well-crafted niche and a well-crafted executor in that niche, it's defensible. It's defensible. So there are barriers to entry into that niche. Nassim Taleb says it's anti-fragile. I like that because it means that you can have a more consistent rate of return. And I would argue a consistent rate of return leads to that eighth wonder of the world, compound returns. As everybody in the panel and everybody in the audience knows, volatility can be extremely detrimental and a drawdown to long-term performance. Furthermore, niche investments generally have less correlation amongst them. Cross correlations frequently aren't really evaluated, and you want to be very careful because that gets to Gary's other comment of widespread diversification. Look, I'm a conservative player. Diversification limits your returns. You know, better to put it all on black 23 on a roulette reel if you know that's going to come up. But I'm a chicken and I would love to get my bacon back, particularly as a lender.
That's great. So let's, I think we'll go through one round with this and then dive into some more detailed ones. Shant, I think we'll go in the same order that we've done it before. Shant, what's your outlook right now?
Sure. I think I really agree with a lot of what you said, Alan. It's a lot about downside protection and focusing on compound interest, certainly. And I think if somebody were to look at my personal portfolio and what we're trying to build at the fund, it might seem very lopsided because we, both I personally and we as a fund, focus purely on technology. And of course, if you unpack that, technology has a number of subsectors, a number of silos that are in many ways uncorrelated with each other, let alone the rest of the market. So I'd say you know, focusing on a niche and just understanding that niche quite well, but then further diversifying within that niche is probably where at least my head is. We're at the peak of another market. You know, we're very focused on downside protection. Nobody really knows how this will all unwind and certainly not when. So that's sort of my 2 cents.
Okay, Mark.
Sure. So similarly to Shant, we are solely focused on investing in the technology sector. I think even as Ari sort of flagged when he was showing his charts on diversification of venture capital investments, we look to identify, you know, great overlooked companies both across the US, but you know, on a selective basis globally as well. We're actively recapping a company that has received a lot of US venture dollars, but it's headquartered in Cambridge, England. And so we identify technology companies. These are typically being identified on a proprietary basis. Rarely will we look at a banked opportunity. The bankers are doing a great job. They're clearing the market. They're squeezing and optimizing for returns typically, and that's a sort of area that we tend not to focus on. So on a proprietary basis, largely leveraging a large set of operating partners that we have in place. We've got 25 operating partners that allow us to scan the US technology sector broadly, to cover a number of sub-verticals and to be able to leverage their unique expertise and capabilities. And when we're looking at these companies, these are companies that have typically all received substantial venture dollars. And the result of that is they've got proven product market fit, they've got referenceable customers, they've got scaled defensive technologies, and importantly, an experienced and motivated management team. And we look to put in the right capital solution. We do not employ a cookie cutter model. As I said at the beginning, we really look to craft the right type of capital, the construct of that capital that really aligns all interests. And, we are not, however, taking early venture risk. We are underwriting to protect our principal. We're underwriting to the downside, but we're able and we feel comfortable looking at a number of factors to allow us to do that. And so notwithstanding the fact we're really looking to have that principal be protected, we are aspiring to equity-like returns as opposed to simply credit-like returns.
Okay, well, that was a nice review. How about you, Peter?
Well, I do take early venture risks, and I am in niche markets, and I look for a problem to solve. And I use my own analytical ability and the fact that I've been doing this for so long to actually come up with a problem solution and a solution and then fund it. And so I'm very interested in anything tech related, very unique products. I'll throw an example. So I'm involved with the country of Vietnam, and I actually have a 10-year contract for all the e-visas being issued to 16 million visitors when travel gets back into the mix again. From the technology basis with some partners that I picked, I have an interest in a portable wind turbine, the first in the world, which can generate off-the-grid electricity, store it, and I'm even exploring a cryptocurrency mining application, that particular one, which completely eliminates the need for any environmental impact and can make money on cryptocurrency mining. But it also produces water and a bunch of other philanthropic applications, and this could be scaled across the world. I also have an interest in digital assets through online stores that can be launched very quickly and very profitably in any number of endeavors. These are all perfect for millennial queen makers that we line up. I get about 50 a day reach outs to fund businesses, to fund these young women who went to businesses. And finally, I look for really blue ocean opportunities. Blue ocean opportunities meaning it's not the Red Sea where all the sharks are fighting with each other. I'm not going to say nobody, but very few people are willing to take the risk that I am on the non-recourse loans that I will do to individuals to get into business. I'll give you an example of a very unusual project I'm working on right now, and it has to do with shark proofing our beaches. I have found a direct connection with orcas, which are the only known predator, apex predator for sharks, including great white sharks. And we're reverse engineering the pheromones of the orca, including the sounds that they make when they attack, and putting that together as a kind of like a package to help people not get eaten by sharks. So I'm very diverse in the things that I get into. That's how I keep interested. I have the attention span of a gnat. And I love what I do, and I'm going to continue to do it until they carry me out feet first.
Okay, so thanks for that. One of the questions that came up here actually from Marty is, how do we hedge our risk on some of these opportunities? In the stock market, you can get a lot of information, especially on stocks that are listed and they have listed options. You can see the straddle price in terms of what's going to happen after an event. You can see volatility spikes in terms of things like AMC or GameStop. So that's giving you a lot of information about a lot of things. On the other hand, other than maybe knowing and trusting a guy or talking to him a long time, and he seems like an overall good guy like Alan, I brought up yesterday about one guy that I knew many years ago, and he says, this is the greatest thing ever. He says, I like whiskey. I'm going to invest in Scotch whiskey or Irish whiskey. And he says they store it for 10 years and all of a sudden I get a big return. And if return's not there, at least I can drink it. Turns out the guy didn't have any whiskey in those barrels. He just took the money and invested in some other thing. So how do you hedge your risk on deals where you really don't have a risk? You know, obviously a building you can put some insurance on, whether it's a fire or earthquake or hurricane or whatever it is. But in terms of a lot of these, how do you hedge the risk? And if they're not hedged, is it just hedging through diversification, or is it hedging in terms of just having only a limited number of these items in your portfolio? And so I think, Alan, for you, how much is appropriate for all of these niche things? Because you definitely have some base somewhere in terms of yours, and not only for yourself, but others. How much would you say you put in these relatively, even though you've got a liquidity event, it's not like the market or something, how much would you put in that and different things, less liquid opportunities?
Well, just simply because we talked about it, to use it as a base case, a proof case, in the art stuff that we're doing, we've lent $85 million against 160 different pieces of art. So by element, we're a hard asset lender. So multiple diversity in the underlying collateral. Second, different genres of art. Third, and we didn't really talk about this, I love short duration. I believe inflation, given the wage increases, is sticky. So I worry about inflation. So we're basically doing one-year term loans. And the fund we have, the duration is 3.7 months. I love that because it actually shockingly matches the liquidity provisions we offer to investors. Next, we're a recourse lender. I like it. So yes, we have recourse against the collateral, which is in our possession in a bonded warehouse. So you don't pay us, we're going to sell the collateral. So I like recourse. We get personal guarantees as another speed bump to implement. So we have all of those kinds of things as a safety net for what we're doing. And I think you can apply similar concepts to the other stuff that we're talking about, particularly short duration.
But how much in terms of a portfolio would you think some assets like yours should be in a person's portfolio? And I guess difference depend on age and risk tolerance, but what would you say is appropriate for that?
Well, I'm a believer. I think alternatives and niche investments can be, this is kind of shocking. The classic thing is a 60-40 portfolio, 60% in equities, 40% in debt. Okay, where do you put the 60% today? As Shant wisely said, given the lofty levels of equity. Okay, so you're going to have to be careful how you deploy that. Where in God's green earth do you put the 40% in debt with interest rates, high yield bonds? Oh my goodness, trading sub 4%. And yes, we all know they default. So where do you do that? So I think alternatives can have a much higher percentage of a portfolio. For example, you think of Yale. Yale has a huge percentage in alternatives and real assets. Harvard, equally so. And as a result, they've outperformed pretty much all other major pools of capital. So I think you can have a much higher percentage than is commonly accepted. And they've done it to their credit.
So Alan, it turns out that your custodian is First Republic Bank. I don't know if you guys can see this, but this is the eagle. I'm actually wearing this mask because it doesn't really have that bad of a logo. The eagle has landed here. And so on something like that, can you actually leverage an investment in your fund? Can you take that investment, pledge the proceeds, and would somebody give you 50% lending, or has it got to come from your own source or a home equity loan, or borrowing from your margin account or?
Gary, is your question, is there a warehouse line?
We do two things.
Yeah.
In the pooled vehicle, very conservative, no more than 15% to any single borrower or any single artist. We recently added a tiny smidgen, half a turn of leverage to that fund. I'm not a big believer in ultra leverage because they have a tendency to blow up. So we have some leverage on that pool of capital, which we're gradually building into it. On our sidecars, which we do a lot, imagine this. We just closed today a $15 million loan against 9 pieces of art yielding 10.5%. Okay, we have some Wall Street types that say, oh, Alan, you should lever those sidecars. My attitude is 10.5% for a 1-year term loan is pretty peppy with fairly low risk. So I say to them, if you want to lever it, be my guest. So we have a little bit of leverage in our pooled vehicle. The sidecars, there is no leverage.
Okay, but how much leverage is in your pooled vehicle?
In the pooled vehicle, for every dollar of equity, there's 50 cents of leverage. Depending
Okay.
how you view that, you can either call it half a turn of leverage. Some people say it's only a third of a turn of leverage. So it's very modest.
Okay, so that's good. You know,
What about loans that are too big for his fund? Like, does he have any loans that he does, like special situations or things like that?
yeah, there's got to be some stuff that you do have some competition, I guess, and if there's something that's too big, so what happens there? You just pass on that?
We would pass, just for everybody's merriment. When we started this 6 years ago, actually, we were just getting into it. So it's really 5 years ago. A big credit fund said, Snyder, I've got this $100 million deal of art, and the art was terrific. And he said, I'll take 60%, you take 40, and you do all the work. And sadly, we passed because we didn't at that time have the 40 million. Today, we can do bigger size deals. But if it was a huge deal, we're looking at one today that's $100 million. We would clearly offer that to some of the credit funds that are now playing with us.
So suppose you had some emerging artist that maybe you thought was a wee bit inflated, say a Hunter Biden painting or NFT, what would happen there?
Well, again, we're in a funny space, you guys. I mean, about every 4 to 6 months, having had a web company, we bought the URL artlending.com, which gets a lot of traffic. About every 3 or 4 months, we get pitched by somebody representing Michael Jackson paintings, Gary, like you're alluding to.
Okay, yeah.
And we say, hey, that's great. Send us an appraisal from a major appraiser and we'll take a look at it, and they always go away. So we're kind of skeptical about highly volatile contemporary art. You know, we've looked at a Basquiat as an example, and we've said, okay, instead of an LTV, we're usually almost always sub 50%. In that case, we said we'd give a 30% LTV because of the price volatility. So we will adjust the LTVs. Again, I think losing money sucks. Particularly, I'm the largest individual investor in what we do. So we're very sensitive to LTVs.
Yeah, it does, because, you know, back in 2008 and 2000, you'd see hard asset lenders who probably only on real estate hit 50 or 60%, suddenly lending 80 or 100% because they said that the appreciation was so good. So I guess so. So I would leave it to Alan to basically make something that's on a canvas into hard asset lending, but it looks like you've done pretty good on that. So maybe I'm going to ask this next question only because it came to my head right now, and you might be the best one to ask. Things like buy now, pay later. You know, a firm's getting bought at a big premium. It's a hot topic. You know, it's basically a guy gets 3 or 6 months of credit, but basically the merchant seller pays for some of that. Turns out that 20% of these guys are already late on their payment. So there's probably some reckoning somewhere or others. So in terms of a lot of these things, there's got to be a risk on it. And even though you don't have, so where is your risk in that portfolio? Is it that there's a meteorite hits the Los Angeles warehouse? Is it, some riots, or is it, where do you see any risk on that? Because from how you explain it, you sound like it's hard to put a risk on it. And how do you hedge that? Only in terms of the 30-40% is really a good deal. So do you have a risk premium on that, or do you insure or lay it off like through Lloyd's, or do you say, hey, we've already got such a low LTV and a diversified portfolio, you don't need to risk it further?
I think buy now, pay later is an attractive space. It's an evolution of merchant cash advance, which has been around and got absolutely, and I think crushed in 08, 09. I think the big risk, and then I'll shut up and let the other panelists talk, is really a regulatory risk. Trump gutted the CFPB. Okay, new administration, the CFPB, a regulator, is going to be a lot tougher, and it's tightening the screws on that new business that's developed. So I think it's a regulatory risk as much as anything else.
Yeah. Okay. So the rest of you guys go ahead.
Sorry, Gary, but just to build on what Alan said there, because it's a very wise comment that he just made. In this administration, you are already seeing the CFPB taking steps, particularly to protect the consumer, as opposed to the enterprise, which is typically in the form of the MCA. But a somewhat similar product to an MCA is an ISA, an income share agreement.
Yes.
And this has been used in a number of novel solutions. And just last week, the CFPB came out with a deliberately vague consent order where they went after a nonprofit originator of ISAs. This nonprofit just didn't have the wherewithal to defend itself and therefore settled. But as part of that settlement, it sort of set in stone this very general, broad definition of what the CFPB will and will not accept. And this is definitely a shot across the bow with regard to how this current administration is re-enabling the CFPB to come after some of these non-banking solutions.
Yeah, so regulation seems like a big risk there. And so perhaps any of you or all of you could talk about where you think the highest risk is. I said it in that there's something like a 1/3 of all the college graduates major in something they really can't get a job in other than working as a barista or a barista. And so maybe they're going to be the guys that are going to be the regulators. They're kind of, completely, yeah. And they're going to hire armies of these guys to do all this stuff. So where do you see the, and the worst is the guys that are, politically correct or, got some revenge politics involved. So where do you see the risks? Shant, why don't you continue on and tell us where, and then we'll go on to Mark and Peter. Where do you see the potential risk in terms of maybe regulations gone wild?
Yeah, look, I'm actually a fan of certain types of regulation. I think there's certain industries that should be regulated. I've spent a lot of time in the Valley. I was part of a giant venture lending leasing company during the dot-com days, and certainly saw a lot of destruction there. But out of that destruction came some pretty amazing companies. And I think what's happening in fintech broadly that regulation is trying to catch up to is that you have this, buy now, pay later is just one of many different fintech technologies that are trying to push the envelope. And what's going to happen is, a lot of those will fall on the wayside. A lot of those will revert back to looking like a bank at the end of the day. Fintech goes brick and mortar kind of evolution. But I do believe regulation, especially around things like crypto and keeping the individual investors safe, is probably a good idea. And some of the destruction is going to happen anyway in terms of broader tech, and that's probably sort of survival of the fittest. That's probably good for broader tech anyway.
Okay, next.
Yeah, I mean, I'm not so sure if I would say this is the greatest risk, but it's an observation that I think is relevant given the construct of today and tomorrow, and that is SPACs, and particularly forward-looking statement disclosure. You know, I think the SPAC market, to an extent, has been fueled because of the construct where, as an acquirer, the company that is being acquired has been able to provide through a safe harbor, has been able to provide forward-looking statements. Surprise, surprise, every one of these are showing a case where by 2025, they justify today's valuation of being $1 billion plus. And I think the level of diligence that has been done on these numbers has, in many instances, been insufficient. You've seen the SEC take action, you know, in one instance that I can think of quite recently, in the case of a company called Momentous that was being acquired by a company called Stable Road. And the SEC forced the sponsor to not only pay a fine, but to give up the entirety of its promote because the SEC deemed that it had done insufficient due diligence, both in the company's prospects, but also the company's underlying technology. And, you know, to the point that Alan made, I think we're just seeing a little bit of a rattling of the saber with regard to future regulation. I think we're going to see significant clampdown with regard to forward-looking statements, which will have major consequence with regard to the profile of company that can be SPAC'd.
Yeah, and the SPACs, as Marty said, those guys are all in hiding. And so
Didn't
from,
say that.
yeah, but he didn't say that. I guess I said that. But it turns out that the SPACs now have turned into a completely different vehicle. Most of them have a $10 redemption, and they're 6 to 12 to 18 months away from the redemption. And so what happens is they're trading at, you know, anywhere between $9.50 and $9.90 or so. So it's actually a bond substitute. You can, with a, you know, rabbit's foot, that if case something jumps above 10, you can bail out. So yeah, it's been a completely different market than what 6 months ago or so when we did have the SPAC. So things do change. What do you think?
Hey, Gary, if I might insert, Mark and Shant made me think of an article that I wrote recently about NFTs, and the technology team here is far more expert at it than I am. But in it, it says, it's on our website, shinnecock.com, but it's called NFTs caveat emptor. And people said to me, oh, Snyder, you hate NFTs. And I don't. But it's where these guys are playing and doing their deep dive on the technology side. NFT technology is extremely powerful. It's early. There are problems with some of the executions where people are going to end up and their NFT is going to disappear. However, it's in those areas that these guys are smart and play in, Shant, Mark, and Peter, where you have this tension of being on an early side, an early technology like NFTs, but oh my goodness, can it be applied more broadly? What about fractionalization of hard assets, whether it's real estate, a Picasso painting, or something like that? And the SEC is lurking in the background, but therein lies some pretty neat opportunity. You got 3 panelists here that are really expert at assessing those risks.
Are people going to be lending against NFTs?
I don't know if they'll be lending. I think what the big play, which we're looking at, is applying the blockchain technology to hard real estate, physical art. There's $1.7 trillion of physical art. 80% of that art is sitting in a warehouse or a vault at a museum. That's going to be liberated. And you're going to have fractionalization of ownership using NFTs because of the richness of the technology of appending all of the provenance of the art to the token itself.
Yeah.
Hey, can you ask them about warrants on what they?
Yeah, so, okay, so then there's always the kickers. You know, we have warrants like Silicon Valley Banks, kind of got a lot of value in terms of all its venture lending. But you have some sort of warrants on your art, I believe, or at least you get some kickers in terms of early redemptions when people want to sell the art. So maybe you can tell us about some of that.
Well, I'm kind of excited. One of the loans we have has a profit participation in it. And the dealer, I love dealers because they need inventory constantly. And it's a Titian painting and looks like they're going to sell it for a bunch of money. And our investors will participate in the delta between what the dealer paid for the Titian and what it's being sold for. So that's a form of warrant like Peter and Mark and Shant are expert at. That's sort of the art equivalency to a warrant, profit participation.
Okay, so you could probably fill up 2 hours now because you got so many ideas, which is just.
I got to shut up.
I know, I love having you on the panel. I got about 50 more questions for you, but we've only got 10 more minutes. But let's go ahead, Shant, you get a lot of warrant participations in your deals and then obviously boosts the return. How important are those participations in your deals?
I'd say they're pretty important. What we like to say is that the way we structure our deals, and again, we are lending not to very young technology companies. We lend to companies that have at least, as a benchmark, about $10-ish million of high quality revenues. And by high quality, I mean from customers that have signed long-term recurring contracts. We talked a little bit about hard assets. One of the most powerful things within technology these days is the recurrence of cash flow streams. I think I'll quote badly Robert Smith at Vista, who said that certain companies will rather not pay their rent in times of distress before shutting off their software vendor. And so this predominance of solid recurring revenue makes even young technology companies that are 10+ million of revenues very, very good borrowers. So when we lend to that stage of technology company, we're trying to get a core yield of 11 to 15%. But then when you add warrants and equity investment rights on top of that, that nudges up the return up into the high teens or into 20. And I think the important thing about warrants is we lend first with a credit mindset. So we enter these companies with a very balanced credit view in terms of downside protection, liquidation value, et cetera. And so when it's time for us to make a follow-on equity investment, we're very knowledgeable about these individual companies since we're getting these detailed reports. So being a lender first and an equity investment second gives us a huge leg up versus other equity investors that come in. Oftentimes, we'll also come in with mostly debt and a small portion of equity directly. So back to your question, Gary, I think in terms of warrants and equity investment rights, it's an important differentiator for our platform, certainly within alternative credit. Technology is one of those few sectors, and certainly art is one of them, where you have very solid sort of collateral base, but you also have this ability to where the asset values can spike and give you a nice return on top of the equity, the credit return.
Yeah, so let's, we only have a few more minutes. Peter, do you have any comments on the importance of warrants to yours?
Sure, and I have a little different take on this because when I loan money to get and start a business or do a venture, I control 100% of the business. And I do that until I've been paid in full with my return. And then I stay on a trailing equity investment in that particular venture forever. That's how I kind of pay it forward. So I'll find people like yourselves, early stage angel investors and VCs, to come in and take me out or that business out down the road, with the individual that I've put into business being able to participate in basically having a business funded by me. But I maintain 100% control, so I don't have to watch my backside or anything else. I own it already. And if I have to put other operators in it, that's fine. And I do, just so you know, every business that I get involved with, we bring in our own management team to make sure it's got the highest and best chance of success. And then the diversification, how does it get more diverse than Vietnamese e-visas and shark proofing beaches? It doesn't really matter what kind of business it's in. If it makes a profit, I'm in it, kind of like Ferengis from Star Trek.
But do you sell any of your thing to individual investors here, or are you basically funding that all yourself, or how's your
You know,
funding?
I'm funding it all myself, but there is going to be a time that I'll be bringing in outside investors. But my little brothers are going to retire soon. One from the Fed, you know, he's got his own $5 billion hedge fund, and my other brother, you know, in the entertainment business. And they sort of invited me to come up to LA to go meet them. And I think they want to start a family office of our own. You know, I'm never retiring. Why the hell would I do that? I'm having the time of my life, starting new businesses, and you know, it's great. But I will be bringing in outside investors in as we get bigger, because as you build a portfolio of companies, they're so diverse. But my returns, guys, are 50 or 60% a year. I don't do the little 11% cover your butts and all that. That's not my style. I'm much smaller businesses, but they can grow. And to Alan's point, I really like that NFT deal you're doing and your art and stuff like that. I'd love to talk to you, because I'm always looking for different things to get involved in. I have the, like I said, I have the attention span of a gnat, but I also have a big appetite for making a ton of money. And if I don't, I clear out the decks and start something else or merge it with whatever. I have complete flexibility because I don't have anybody else telling me what to do. But
Yeah, it
that's,
seems like you would be good to just wrap a lot of the businesses that are, you know, already got some aging in them, and put them all together in a fund for individual investors, because it would be a pretty diverse fund. Well,
Totally.
yeah, so we're almost out to the to the thing besides the, you know, what's with the red shirt dude. Is there any other questions from the audience? Anybody have any questions?
So can they talk about how many of them have funds versus assembled loans versus SPVs? I guess that Peter just answered the question, but how about the others? So Alan has a fund, but Alan doesn't do any SPVs?
Yeah, Alan?
Well, do we, the sidecars are done as straight loan participations, familiar to the rest of the team, no doubt. So that's a direct investment. The fund, I think, you know, in credit funds, I'd love to throw this out to the audience and the team. We had the luxury of starting with a blank sheet of paper, so we were able to structure it so there is no effectively connected income, no need for a Cayman feeder and all that mumbo jumbo, which if things go south are a major problem. So it saves an offshore investor about 200 basis points. There's no UBTI, great. And we deduct pre-tax the investment expenses, as opposed to, you know, it appears magically in somebody's K1 as an oops, we forgot to tell you about this expense. So that's the two different ways for us.
So does that mean?
I have a question.
Like a Roth or something like that, a tax advantaged account?
Yeah, we accept tax qualified money. I have a question as an audience, since for the brain trust on this panel. Do you guys, you technology guys, look at IP sort of like we look at art as a hard asset? Do you look at the IP in some of your investments almost as a hard asset that is bankable?
I can go first quickly, Mark. We don't actually look at IP as a hard asset. Main reason is we come into companies that have already proven themselves as a business model. You know, we prefer companies that have very strong recurring cash flows, and by cash flows, I mean recurring revenues, cash inflows on that sense. You know, these are companies that have proven their IP already. We're not testing any product out. We recognize that these companies should belong, as they mature, inside a portfolio of you know, one of the major acquirers or within a PE fund or something like that. So we'd rather lend against the enterprise value. That's our singular focus, as opposed to you know, a pool of intellectual property.
Okay, so I guess we're all, any quick closing comments? We're ready for the next comment, but anybody else that's not gonna be able to sleep if they don't make the parting comment? I guess not. I hope you guys didn't scare away. Well, thank you a lot. It's always a lot of fun to have them, and you know, next time, I don't know when the next one is, but be glad to do it. Okay, thanks
Thank you,
everybody.
Gary.
Thanks, Gary. Great job.
Gary, thank you.